I've watched people repeat the same mistakes for decades, and the root cause is always the same. They believe they can outsmart the market. They listen to whispers, they follow gurus, they trade on emotion. They try to predict the future. And for 40 years, I've watched them fail. I've seen brilliant minds, celebrated analysts, and self-proclaimed visionaries burn out, lose fortunes, and walk away defeated. They all made the same fundamental error. They mistook storytelling for strategy. They believed in the romance of the heroic investor who, through sheer genius, could foresee the market's next move. That is a dangerous illusion. The market is not a narrative to be interpreted. It is a complex system of cause and effect, a vast ocean of data, and it does not reward intuition. It rewards discipline. It does not bow to predictions. It yields to mathematics. I don't predict the market, and that is why I have won. Most people approach investing as if they are trying to solve a puzzle with a single hidden solution. They search for that one piece of information, that one secret indicator that will unlock the market's code. They read every financial report, they chart every stock, they hang on every word from the Federal Reserve. They are convinced that if they just work hard enough, if they are just smart enough, they will be able to see what others cannot. This is the great intellectual trap of modern finance. It is the belief that the market is a knowable entity, that it has a consciousness that can be understood and anticipated, but the market has no memory of your past successes, no concern for your future hopes, and no interest in your well-reasoned arguments. It is a relentless, indifferent machine that processes information and probabilities. The moment you begin to believe you have a special insight, the moment you feel a surge of confidence after a winning trade, you have already lost. That feeling, that emotion, is the signal that you have abandoned logic and embraced chance. The traditional approach to investing is built on a foundation of sand. It is based on the flawed premise that human judgment can consistently outperform a systematic, data-driven process. It cannot. Human beings are wired for narrative, for emotion, for bias. We see patterns where none exist. We fall in love with our own ideas. We are swayed by fear and greed. These are not flaws to be overcome through willpower. They are fundamental aspects of our cognitive architecture. To believe you can simply ignore them is the height of arrogance. The greatest investors are not those who have the best predictions, but those who have the best systems. They are the ones who have removed their own ego from the equation. They have accepted the limits of their own foresight and have instead built a framework that can thrive in a world of uncertainty. Today, I will not give you stock tips. I will not tell you what the market will do tomorrow. Instead, I will show you the 3 fatal mistakes that keep investors trapped in a cycle of mediocrity. These are the errors that I see repeated day after day by individuals who are otherwise intelligent and capable. And I will give you the principles that have guided me not to predict the market, but to systematically extract value from it. First, let's discuss the illusion of control. The human mind craves certainty. It is an evolutionary trait that has served us well in many areas of life. But in the financial markets, it is a catastrophic liability. The desire for control leads investors to believe they can influence outcomes through sheer force of will or intellect. They create elaborate narratives to explain random market movements, convincing themselves that they understand the why behind every fluctuation. I once knew a physicist, a man with a truly exceptional mind, who became obsessed with the stock of a small technology company. He had done his homework. He understood their product, he had met their management team, and he had built a detailed model of their projected earnings. He was convinced that the stock was undervalued, that the market had failed to appreciate its true potential. He bought a significant position, and for a while, the stock performed as he expected. He felt a sense of validation, a feeling that his superior intellect had given him an edge. But then, an unexpected geopolitical event sent a shockwave through the global economy. The market sold off, and his chosen stock fell with it. His model had not accounted for this. His deep understanding of the company was irrelevant. He had made the classic mistake of confusing knowledge with control. He knew everything about the tree, but he was standing in a forest that was on fire. The market is not a laboratory where variables can be isolated and controlled. It is a chaotic ecosystem of interconnected systems where a butterfly flapping its wings in one corner of the world can trigger a hurricane in another. To believe you can control any part of it is to fundamentally misunderstand its nature. The only thing you can control is your own process. You can control your inputs, you can control your risk, and you can control your reactions. My approach has always been to build models that are agnostic to the why. I do not care why a particular stock is moving up or down. I only care that my models have identified a statistical anomaly, a pattern in the data that has a high probability of repeating. These patterns are not based on stories or narratives. They are based on the cold, hard logic of mathematics. We collect vast amounts of data, we test countless hypotheses, and we build systems that can execute trades without human intervention. We are not trying to control the market. We are trying to build a surfboard that can ride its waves. The illusion of control is a siren song that has lured countless investors to their doom. It is the belief that you are the captain of your own ship, navigating the treacherous waters of the market. But you are not the captain. You are a passenger on a very large, very unpredictable ocean liner. Your job is not to steer the ship, but to understand the currents and the tides, and to position yourself accordingly. This illusion is reinforced by the very language we use to talk about investing. We speak of beating the market as if it were a personal adversary to be conquered. We celebrate investors who make bold, contrarian bets and win, as if they were heroic warriors who had slain a dragon. But the market is not a dragon to be slain. It is a force of nature, like gravity or electromagnetism. You cannot beat gravity. You can only understand its principles and use them to your advantage. You can build an airplane that can fly, but you cannot will it into the air. You must respect the laws of physics. In the same way, you cannot beat the market. You can only understand its statistical properties and build a system that can exploit them. The illusion of control is also a product of our own ego. We want to believe that we are special, that we have a unique insight that others lack. We want to believe that our successes are the result of our own skill, and our failures are the result of bad luck. This is a comforting narrative, but it is a false one. The reality is that the market is a humbling place. It has a way of reminding even the most brilliant minds of their own limitations. The moment you start to believe that you are smarter than the market, you are already on the road to ruin. The only way to survive in the long run is to have the humility to accept that you are not in control. You must be willing to submit to a system, to a set of rules that are based on data and evidence, not on your own intuition or ego. This is not a sign of weakness, it is a sign of strength. It is the recognition that the whole is greater than the sum of its parts, and that a well-designed system can achieve what no single individual can. Second, we must address the poison of prediction. The financial media is a relentless machine that churns out predictions 24 hours a day, 7 days a week. Analysts, economists, and strategists are paid to have an opinion, to forecast the future, to tell you where the market is headed. And the public consumes these predictions with an insatiable appetite. They are looking for a shortcut, for a way to avoid the hard work of thinking for themselves. But I will tell you a secret that the financial industry does not want you to know. Nobody can predict the market. Not me, not the most celebrated hedge fund manager, not the most sophisticated AI. The number of variables that influence financial markets is so vast, the interplay between them so complex, that any attempt to forecast their future state is an exercise in futility. It is like trying to predict the exact location where a single grain of sand will land in a hurricane. I learned this lesson early in my career. When I first started my fund, I hired a group of brilliant mathematicians and physicists. We were confident that we could use our knowledge of mathematics to build models that could predict market movements. We spent months developing complex equations, testing them against historical data, and refining our algorithms. We were convinced we had cracked the code. But when we finally deployed our models in the real world, they failed. They failed because they were designed to predict the future, and the future is not predictable. We had made the mistake of believing that the past was a perfect guide to the future, but the market is a constantly evolving system. The rules of the game are always changing. The patterns that worked yesterday may not work tomorrow. It was a humbling experience, but it was also a liberating one. It forced us to abandon the fool's errand of prediction and to embrace a new approach. Instead of trying to predict where the market was going, we started looking for statistical anomalies, for small, fleeting inefficiencies that we could exploit. We were no longer trying to be prophets. We were trying to be plumbers, fixing the small leaks in the vast, complex plumbing of the financial markets. We built systems that could identify these leaks and execute trades to profit from them. We were not making big, heroic bets on the future. We were making thousands of small, statistically sound bets every day. The poison of prediction is not just that it is impossible. It is that it distracts you from what is truly important. It encourages you to focus on the unknowable while ignoring the knowable. You cannot know what the market will do tomorrow, but you can know your own risk tolerance. You can know your own time horizon. You can know the statistical properties of your own strategy. Focus on what you can control, not on what you cannot. Build a system that is robust, that can withstand the inevitable storms of the market, and most importantly, have the humility to accept that you do not know what the future holds. The allure of prediction is deeply rooted in our psychology. We are pattern-seeking creatures, and we have a natural tendency to see order in randomness. We look at a chart of stock prices, and we see trends, we see support and resistance levels, we see head and shoulders patterns. We are convinced that these patterns have predictive power, that they can tell us what the market will do next. But the reality is that most of these patterns are just noise. They are the random fluctuations of a complex system, and they have no more predictive power than the patterns in the clouds. I once had a conversation with a very successful trader who told me that his secret was to read the tape. He claimed that he could watch the flow of orders in the market and get a feel for where the price was going. He was a very charismatic and convincing individual, and for a while I was intrigued by his approach. But then I asked him a simple question. How do you know that what you are seeing is not just a random fluctuation? He had no answer. He was a victim of his own intuition. He was seeing patterns that were not there, and he was attributing his success to his own skill, when in reality, it was probably just a matter of luck. The problem with relying on intuition is that it is not testable. You cannot build a system around a feeling. You cannot backtest a hunch. You cannot know if your intuition is a reliable guide to the future or if it is just a product of your own biases and emotions. This is why I have always insisted on a rigorous, scientific approach to investing. Every strategy that we deploy is based on a clear, testable hypothesis. We collect the data, we run the numbers, and we let the evidence speak for itself. If the evidence supports our hypothesis, then we will deploy the strategy. If it does not, then we will abandon it and move on to the next one. There is no room for intuition or guesswork in our process. We are not trying to be artists. We are trying to be scientists. We are not trying to create a masterpiece. We are trying to build a machine that can generate consistent, reliable returns year after year. This is a much less glamorous approach than trying to predict the market, but it is also a much more effective one. Third, and finally, we must confront the tyranny of emotion. Greed and fear are the two most powerful forces in the financial markets. They have been responsible for every bubble and every crash in history. They are the twin demons that whisper in the ear of every investor. urging them to abandon their discipline and to follow the herd. I have seen it time and time again. An investor has a well thought out plan, a diversified portfolio, and a long-term perspective. But then the market starts to rally. They see their neighbors getting rich. They read stories of overnight millionaires, and the greed begins to take hold. They abandon their plan and start chasing hot stocks, convinced that this time is different. Or the market starts to fall. They see their portfolio value decline. They hear predictions of a coming crash, and the fear begins to take over. They sell everything, locking in their losses, and vow never to invest again. In both cases, the result is the same. They have allowed their emotions to dictate their investment decisions. They have become their own worst enemy. The only way to defeat the tyranny of emotion is to remove it from the equation entirely. This is why I have always believed in a systematic, quantitative approach to investing. Our models are not subject to greed or fear. They do not get excited after a winning streak, and they do not panic after a losing one. They simply execute the strategy that they have been programmed to execute day in and day out without emotion or bias. I remember a time in the early days of my fund when we had a particularly bad losing streak. Our models were not performing as expected, and we were losing money every day. The pressure was immense. My partners were starting to question our approach. They wanted to intervene, to override the models, to do something, anything, to stop the bleeding. It was a tempting proposition. It is human nature to want to take action in the face of adversity. But I knew that the moment we abandoned our system, the moment we allowed our emotions to take over, we would be lost. I gathered my team and I told them, we will not deviate from the plan. We will trust the mathematics. We will let the system do its work. It was one of the hardest things I have ever had to do. But we held the line, and eventually the market turned, our model started working again, and we recovered all of our losses and more. That experience taught me a valuable lesson. The most important quality for an investor is not intelligence, but discipline. It is the ability to stick to your plan, even when it is painful, even when every instinct in your body is screaming at you to do the opposite. The tyranny of emotion is a powerful force, but it can be defeated. It can be defeated by having a system, by having a plan, and by having the discipline to stick to it no matter what. The human brain is not designed for the modern financial markets. It is designed for a world of immediate threats and opportunities, a world where the fight or flight response is a matter of life and death. In that world, it makes sense to be fearful when you see a predator, and it makes sense to be greedy when you find a source of food. But in the financial markets, these same instincts can be disastrous. The market is not a predator that is trying to kill you. It is a complex system that is simply following its own internal logic. And a hot stock is not a source of food that will nourish you. It is a speculative asset that could just as easily lose all of its value. The key to success is to recognize that your own brain is not your friend in the world of investing. You must learn to distrust your own instincts, to question your own emotions, and to rely on a system that is based on logic and evidence, not on fear and greed. This is not an easy thing to do. It goes against every fiber of our being, but it is absolutely essential if you want to survive and thrive in the long run. I have seen many brilliant people fail as investors, not because they were not smart enough, but because they were not disciplined enough. They allowed their emotions to get the better of them, and they paid the price. Do not be one of them. Build a system, trust the system, and let the system do the work. Your future self will thank you for it. So, what is the alternative? If prediction is a fool's errand, if emotion is a poison, if control is an illusion, then how does one succeed in the world of investing? The answer is simple, but it is not easy. You must become a scientist of the market. You must abandon the search for certainty and embrace the world of probabilities. You must replace intuition with data and storytelling with mathematics. You must build a system. A system is a set of rules that governs your investment decisions. It is a framework that tells you when to buy, when to sell, and how much to risk. It is a machine that you design and build, and then you let it run. The beauty of a system is that it is unemotional. It does not get greedy, it does not get fearful, and it does not fall in love with its own ideas. It simply executes its instructions day in and day out with relentless consistency. Building a system is not a simple task. It requires a deep understanding of mathematics, statistics, and computer science. It requires access to vast amounts of data and the computing power to process it. But the principles behind it are accessible to everyone. The first principle is to have a testable hypothesis. Do not simply buy a stock because you have a good feeling about it. Formulate a clear, specific hypothesis that can be tested against historical data. For example, you might hypothesize that stocks with a low price to earnings ratio tend to outperform the market over the long run. This is a testable hypothesis. You can go back and look at the historical data and see if it is true. The second principle is to have a large sample size. Do not draw conclusions from a small number of trades. The market is a noisy place, and it is easy to be fooled by randomness. You need a large number of data points to be confident that your results are statistically significant. The third principle is to be rigorous in your testing. Do not cherry-pick the data that supports your hypothesis. Be honest with yourself about the results. If the data does not support your hypothesis, then you must be willing to abandon it and move on to the next one. The fourth principle is to manage your risk. No matter how good your system is, you will have losing trades. You must have a plan in place to manage your risk and to ensure that no single trade can wipe you out. This means using stop losses, diversifying your portfolio, and never risking more than you can afford to lose. The fifth and final principle is to be patient. Building a successful investment system takes time. It is a process of trial and error, of constant refinement and improvement. There will be times when you feel like giving up. There will be times when you question your own abilities. But if you are persistent, if you are disciplined, and if you trust the process, you will eventually succeed. This is the path that I have followed. It is not a path for everyone. It requires a certain kind of mindset, a certain kind of temperament. But for those who are willing to embrace it, it is a path that can lead to extraordinary results. This scientific approach to investing is not just about making money. It is about a way of thinking, a way of seeing the world. It is about the pursuit of truth, the rejection of dogma, and the embrace of evidence. It is about the recognition that the universe is a complex and beautiful place, and that the only way to understand it is through the language of mathematics. When you adopt this mindset, you will find that it applies to many other areas of your life as well. You will become a better thinker, a better decision maker, and a more humble and open-minded individual. You will learn to see the world not as a collection of random events, but as a system of interconnected patterns. And you will discover that the same principles that can lead to success in the financial markets can also lead to a richer and more fulfilling life. I have shared with you the core principles of my philosophy. I have told you why I do not predict the market and why I believe that a systematic, data-driven approach is the only path to long-term success. Now, it is your turn. I want you to think about your own investment process. Are you a predictor or are you a scientist? Are you driven by emotion or are you driven by data? Are you relying on stories or are you relying on systems? I encourage you to leave a comment below and to share one thing that you will do differently after watching this video. How will you apply these lessons to your own life? How will you begin the process of building your own system? And if you have found this information to be valuable, I ask that you like this video and subscribe to this channel. We are building a community of rational, disciplined investors who are committed to thinking smarter, investing wiser, and building a better future for themselves and their families. The journey is not an easy one, but it is a worthy one, and it begins with a single, simple decision to stop predicting and to start thinking. To summarize what we have discussed today, First, we have seen that the desire for control is an illusion. You cannot control the market, but you can control your own process. Second, we have learned that prediction is a poison. You cannot know the future, but you can know the statistical properties of your own strategy. And third, we have confronted the tyranny of emotion. You cannot eliminate greed and fear, but you can build a system that is immune to them. The path to success in investing is not through prediction, but through process. It is not through genius, but through discipline. It is not through stories, but through systems. This is the mindset that has guided me for 40 years. It is the mindset that has allowed me to navigate the most turbulent of markets and to achieve a level of success that I never thought possible. And it is the mindset that I believe can help you to achieve your own financial goals. Thank you for your time, and remember, think smarter, invest wiser, and build your future the Jim Simons way.